Borrowing money can help your business grow. But what about writing off the interest on that debt? If you've taken out loans to finance equipment, real estate, or operations, this part of the tax code matters more than ever. The One Big Beautiful Bill makes important updates to the business interest deduction rules. And if you're not careful, it could limit what you deduct. The One Big Beautiful Bill preserves the business interest deduction, but it tightens the rules for larger businesses with more leverage. It continues the Section 163J limitation, which caps the amount of deductible business interest to 30% of your adjusted taxable income, ATI. But One Big Beautiful Bill updates the definition of ATI, removing depreciation and amortization starting in 2025. In other words, you may not be able to deduct as much interest as before. Here's the breakdown. If your business borrows money to buy equipment, property, or fund operations, the interest you pay is typically deductible. But under Section 163J, businesses with more than $27 million in gross receipts in 2025 must calculate a limit on how much of that interest they can deduct. The cap is 30% of adjusted taxable income. And now, with depreciation no longer added back in, that number just got a lot smaller for capital-heavy businesses. The Tax Cuts and Jobs Act created the original limitation, but it included a temporary reprieve. Under 2021, businesses could add back depreciation, amortization, and depletion when calculating ATI, which made the cap more generous. That temporary relief has expired, and now the One Big Beautiful Bill makes it permanent policy to exclude depreciation and amortization from the ATI calculation. The result? Lower ATI equals lower interest deduction limit. This may hit industries like real estate, construction, or manufacturing the hardest. This change mostly affects businesses with over $27 million in annual gross receipts, real estate companies with heavy debt and depreciation, capital-intensive businesses like auto, energy, or manufacturing, investors with leveraged partnerships or pass-throughs, and anyone using financing to scale quickly. Small businesses under the threshold are still exempt from the 163J cap. But if you're close, it's time to pay attention. Here's an example. Your business earns $3 million in adjusted taxable income, and you pay $1.2 million in interest on business loans. Under Section 163J, you're limited to deducting 30% of ATI. That's $900,000. The remaining $300,000 gets carried forward to future years. Now, if depreciation and amortization were previously included in ATI, that cap might have been much higher. But under the new rules, your deductible interest could shrink, and your taxable income goes up. Pro tip: if you're a growing business that uses debt strategically, structure matters. Consider lease versus buy decisions more carefully. Evaluate how much leverage your business really needs. Run projections that account for the 30% ATI cap. Use entity planning to stay under the gross receipts threshold. And if you're in real estate, look into the real property trade or business election, which lets you opt out of the cap in exchange for using slower depreciation. This is one of those deductions that requires a game plan. Don't wait until tax season to find out you lost part of it. Glad you could join us. If you're ready for a smarter approach to taxes, check out Taxsmithing, our personalized tax strategy process. Reach out to us anytime.